Good morning, Shana Tova, and welcome to the Shenkman Wealth Management Accountant Attorney Fall webinar series. This program is entitled Portability and the Proposed Regulation on Estate Tax Deductions. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, U.S. News and World Report, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speaker, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Bruce Steiner of Counsel at Kleinberg, Kaplan, Wolff, and Cohen PC based in New York City. Bruce has over 40 years of experience in the areas of taxation, estate planning, business succession planning, and estate and trust administration. He's a frequent lecturer at continuing education programs for bar associations, CPAs, and other professionals. He's also co-author of CCH's Roth IRA Answer Book and has written numerous articles for estate planning, DNA Tax Management, Estate Gifts and Trust Journal, Trust and Estates, the Journal of Taxation, Probate and Property, Taxes, the CPA Journal, the CLU Journal, and other professional journals. Bruce has been quoted in various major news publications, including CNBC, Fox Business, Forbes, the New York Times, Wall Street Journal, to name just a few. Today, Bruce will be speaking on portability and the proposed regulation on estate tax deductions. With that introduction, I'll now turn the program over to Bruce.
Thanks, Jonathan, and thanks for having me back again. I actually slightly updated the outline late last night. Don't know how I had the energy to do that, but I did. So I will send it to you. If you're going to send it out again tomorrow, you might as well send them the latest and greatest version, although it's only slightly different.
Yeah, no problem.
So here's more of who I am, but you'll see it in the outline when you get it. So what is portability? Portability says that the surviving spouse gets the benefit of the deceased spouse's unused estate tax exclusion amount. And let's just take a very simple example. Spouse one dies this year. The estate tax exclusion amount is $12,060,000. Next year, it's expected to be $12,920,000. We don't have the official word yet, but that's the expected amount. So let's say that spouse one's taxable estate is $1 million. Maybe spouse one left $1 million to a child or a friend, and everything else to the spouse. So the decedent only used $1 million of his or her exclusion amount. So under the old law, what was not used was wasted. If you left everything to your spouse, when the exclusion amount in 2001, it was $675,000. And let's say each spouse was worth $1 million and spouse one died and left everything to spouse two. Spouse two got only his or her own $675,000 exclusion amount, and spouse one's exclusion amount was wasted. So portability says that if you elect it, the surviving spouse takes over the unused amount, in this case, $11,060,000, and that gets added to the surviving spouse's own exclusion amount. So it allows another option. We'll talk a little bit about the options later, but it adds the option of just leaving your estate to your spouse rather than having to create a credit shelter trust for your own exclusion amount or leaving it to your children or to somebody other than your spouse. So what's the history of portability? It was first enacted in the 2010 Act, the Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act of 2010. I don't quite know what the act, how you can say the acronym for it, but the 2010 Act, you may remember under the 01 Act, the estate tax exclusion amount was increased gradually through 2009, and there was to be no estate tax in 2010, and then it would come back in 2011, and it would drop back down to $1 million. So in 2010, right in December of 2010, Congress retroactively reinstated the estate tax for 2010, gave estates of 2010 decedents the option to elect carryover basis in lieu of estate tax, kicked the bucket down 2 years, and just extended the $5 million exclusion amount for 2 years, but introduced portability to be effective only for 2 years, for 2011 and 12. And then Congress on January 2nd of 2013 enacted the American Taxpayer Relief Act of 2012. So I like to say they did it on December 33rd of 2012. And that extended the $5 million exclusion amount indexed for inflation, made it, quote, permanent. Permanent doesn't literally mean permanent. Permanent just means that it's not scheduled to sunset, that if Congress does nothing, it will continue in effect until Congress does something. So that made portability permanent. And at this point, I think we can safely assume that at least for the foreseeable future, it will remain in effect because nobody seems to be opposed to it in the Congress or in any of the administrations since 2010, Obama, Trump, Biden administrations. Perhaps we have it because the UK had it first. Much of our tax law we copy in one way or another from the UK, and the UK had portability first, and we copied it. The difference is that in the UK, the spouse gets to elect it. In the US, the executors of the decedent have to elect it. And in the UK, there's some indexing for the portability amount. In the US, there is no indexing. So if I die today and I leave my entire estate to my spouse and she gets a $12,060,000 deceased spousal unused exclusion amount, the DSUI amount, the portability amount, if you want to call it that, that amount is fixed, whereas her own exclusion amount is indexed with inflation. So that's one of the disadvantages of portability that we'll get to in a minute. So you elect portability on the estate tax return. You don't have to, when you file the return, you don't have to do anything special to elect portability. You are deemed to have elected portability unless you affirmatively opt out of portability, which nobody ever would, because there's no benefit to opting out of it. So now, if the estate is required to file a return, the election has to be made on a timely filed return, including the 6-month extension. The due date is 9 months after death. The IRS is allowed to give you a 6-month extension. If you apply before the 9-month initial due date is over, the extension is automatic. You don't need a reason. If you apply after the 9 months are up, you need to show a reason. The reason has to rise to the level of the same reasonable cause that would let you avoid a penalty, but it gives you 2 bites at the apple. You can first claim reasonable cause. Well, you can first claim that you had a good reason and they should approve the election, and if that fails, you can argue that you had reasonable cause and you shouldn't pay the penalty. I actually had that happen recently. I was the administrator of in New York for the estate of an Israeli decedent who owned property in New York. There was no executor appointed in Israel. Apparently, their process is different from ours in that regard. It's more like some of the civil law countries. But I wasn't appointed administrator here until after the 9 months were up. So I had to ask the IRS to, between 9 and 15 months, to say I had a good reason for not being able to file that extension within the 9 months. So please approve my extension. And it took a bit of correspondence back and forth before they did. That wasn't for portability. That was just to not pay estate tax on the U.S. property. If, however, and what does it mean to be required to file a return? Well, for a U.S. person, it means having a taxable estate plus your adjusted taxable gifts of over $12,060,000 this year, whatever the amount of the exclusion amount is, including what you used up while you're alive. If you're over that level, your return is required. Even if you don't pay estate tax on the return, it's still required. And if you want portability, you must file that return on time, including extensions. If you are not required to file a return, and that's the vast majority, that's over 99% of all estates are under $12 million. Those estates are not required to file a return. The IRS has discretion to extend the deadline for electing portability. And there were so many people who didn't file on time that asked the IRS for permission to elect portability, which requires a private letter ruling, that in 2017, the IRS issued a blanket extension of up to 2 years after death to elect portability if you're not required to file returns. And then just this year, saying that they were still had too many rulings to issue, they changed the blanket extension to 5 years after death, saying that the overwhelming majority of the ruling requests were between 2 and 5 years after death, and that would eliminate most of those ruling requests. All of the rulings that I've gotten, and I've gotten a few, were people that had waited more than 5 years. How does that happen? Well, invariably, either the spouse consults somebody else for her planning, or maybe the children spot the issue when they're doing their planning and they tell the surviving spouse. Or in one case, the lawyer who handled the estate realized that he made an error, and then he asked me to get him a private letter ruling. Both because I've done more ruling requests, and I don't think this would have been his first, and also because it's easier if someone else comes in and says it was just an error, rather than him having to file it saying that it was an error. So and a couple of other reasons it probably gets spotted more often now. With the substantial increase in the stock market in recent years, and I know this year, has been an exception to that. But as I was saying to Jonathan before we started, the level today is about where it was at the beginning of 2021. So if you sort of didn't look at the stock market since then, you would have said, "Oh, gee, it's way up," and then it's been sort of flat for the last year and a half. The market is still way higher than it was a bunch of years ago, and so people who thought they would never have estates big enough to pay estate tax are now saying, "Hey, gee whiz, the surviving spouse may well have an estate big enough to pay estate tax," especially if the exclusion amount reverts. Under current law, it is scheduled to revert to the 2017 level indexed for inflation in 2026, and that means $6,030,000 indexed from 2022. It's not exactly pre-2018 law because they changed the way the inflation adjustments are calculated, but ignoring that for the moment. But for that, it would now be 12,220,000 instead of 12,060,000. Ignoring that, people may be more conscious of it because 2026 is getting closer. We're more than halfway through the 8-year period of the temporary income tax and estate tax changes in the 2017 law. There's also been some discussion, some proposals to reduce the exclusion amount all the way back to the 2009 level of 3.5 million. It was in the Obama administration's revenue proposals for a few years. The Trump administration did not issue the annual revenue proposals. The Biden administration has resumed issuing that. I think it was in the Biden proposal. Will it get any traction? There's no way to know. The 2012 Act was a compromise. The Republicans wanted 35%, who controlled the Congress at the time, wanted a 35% estate tax rate. The Democrats who controlled the White House wanted a 45% estate tax rate, and that's how we ended up with 40. And they compromised at making the exclusion amount permanent at $5 million index. That took a lot of the pressure off the issue because the average person is going to be way below 5 million, and you make it 5 million, the average person loses interest in that issue. So when should an executor elect portability? My view is that if there's any reasonable chance, and I'm ignoring lottery tickets, that the spouse could otherwise have a taxable estate, even if the exclusion amount is reduced to pre-2018 law, which would be about 6 million, even if the 3.5 million proposal is enacted and it drops to 3.5 million. In any of those possibilities, and keeping in mind that stocks have historically done on average pretty well, not every year. That's sort of why they on average do well, because they did well every year, then on average maybe wouldn't do so well. I don't know. So if the spouse could live on for another 10, 20, 30 years, the spouse's estate could grow quite a bit. And the benefit, if you need it, way outweighs the modest cost of doing an estate tax return. And you've got to do most of the work anyway. You've got to prepare inventories in estates. You've got to prepare, depending on what state you're in, you may have to prepare an accounting for the estate. You certainly have to determine the basis of the assets, although that wouldn't apply to an IRA. In about a third of the states, there are state, estate, and inheritance taxes. Some of them have exempt amounts way lower than the federal. So you've got to do most of the work anyway. You might as well elect portability. I really think that's important. I really think you can add a lot of value to your practice and to your clients by making sure to remind your clients that they ought to elect portability. We do it as we sort of assume it, and if somebody insists on not doing it, well, the client gets to decide. But we just sort of treat it as one of the things that we need to do where it's appropriate. What happens in second marriages with children from before? This is becoming more and more common as people live longer and as people move around a lot. So if you've got children from your previous marriage, you might leave your estate to your children from your previous marriage. The spouse might not be an executor. The spouse might not even be a beneficiary. But the spouses might want a portability election. And the children might say, well, gee, you want us to spend our money to give you the benefit of a portability election? You're not even a beneficiary of this estate. We don't have a duty to you. Why should we spend our money to give you this benefit? one can argue that the spouse is a beneficiary to the extent of the portability election. And this actually went to court. I'm only aware of one reported case on it, the Vose estate in Oklahoma, went all the way up to the Oklahoma Supreme Court, and the Supreme Court, in what I think was a very wise decision, required the executors to make the election, provided the spouse paid the cost of making the election, because the executors otherwise didn't want to make it. In a prenup, you may want to consider requiring that the election to be made if the spouse wants it. You might even require that the spouse be named at a minimum as a special executor with the authority to make that election. So what are some of the estate planning opportunities that the portability election gives us? We somehow skipped over that slide, but this is as good a place for it as any. So in the past, you absolutely needed a credit shelter trust because there was no portability. Your typical sort of middle-class couple worth $1.5 million, you needed a credit shelter trust to avoid the estate tax, or at least shelter the credit shelter of the exempt amount from estate tax in the surviving spouse's estate. And there's still benefits to that because the portability amount is not indexed for inflation, whereas the credit shelter trust can grow over time. Depending on what state you're in, you might want to shelter the lesser of the federal or the state exclusion amount. Remember that that almost all of the states don't have portability. Maryland has it, Hawaii has it, there may be another one, most of them don't. So a common plan is you shelter the lesser of the federal or the state exclusion amount. Another plan for younger people particularly, you just leave everything to the spouse, and you have a disclaimer trust as a backup, so the spouse gets to decide whether to take it all, rely on portability, even though it's not indexed for inflation and it may not work for state and it doesn't work for GST. Another possibility is to leave it all to a marital or Q-tip trust with a disclaimer trust as a backup, and that's essentially the same as all to the spouse with a disclaimer trust as backup, except it does two more things. First is the assets are going to be in trust one way or the other for those who want the spouse to be provided for in trust. And the other is you make a Q-tip election for estate tax, but you can make a reverse Q-tip election and not treat the spouse as the transferor for GST and use the deceased spouse's GST exemption on it. And that gives you some people view it as the best of all worlds. It also gives you the second basis step up for what goes to the marital trust or to the spouse outright, whereas the credit shelter trust does not. And finally, there's the Clayton Q-tip trust, which says, I leave my estate to my trustees to the extent my executors elect Q-tip. It goes to a marital trust. To the extent my executors don't elect Q-tip, it goes to a credit shelter trust. And that's another option. It just lets the executors rather than the spouse decide. So we have a few minutes left, and I just wanted to touch on the new proposed regulations on estate tax deductions. They just came out. They're not in final. The final regulations may change from the proposed. We don't know. But in the Congress the IRS rather was concerned that under current law, you got estate tax deductions as of the estate tax due date, regardless of when they were paid. So for example, if you borrowed money to pay the estate tax and the note was a long-term note, you took a deduction up front for all the interest that you were going to pay. If there was no prepayment option, it was deductible all at once. If there was a prepayment option, you only got to deduct it as it was paid. And that was a whipsaw because you got to deduct it up front, even though the present value was much, much less because some of those payments were paid later. So under the proposed regulations, there's a 3-year grace period. Anything paid within 3 years of death, you get to deduct in full. Anything that's not paid till more than 3 years after death, you only get to deduct the present value of the interest or whatever the expenses that's paid more than 3 years after death. And you use the AFR, which is presently in the threes. It's the average of what the government pays on government notes or bonds, either in the 0 to 3 categories. The short term, the 3 to 9 years, the midterm, and the over 9 is the long term. At the moment, they're all pretty close to each other. The 6166 interest has a different rule. That is not deductible, but the interest rate on the deferred payments, that's if you have a closely held business that's at least 35% of your estate. The estate tax on that closely held business interest is deferred over 5 years of interest payments and 10 years of principal and interest payments. You get up to 14 years and 9 months. And the interest on that is 45% of the regular rate. The regular rate is now 6. So the interest rate right now is 2.7, and that changes every quarter. On non-6166 interest, the regulations remind people that to deduct the interest and the loan have to be bona fide, and the loan and its terms have to be actually and necessarily incurred in the administration of the estate and be essential to the proper settlement of the estate. In other words, you had to need to borrow money to cover the liquidity. If you had cash to pay the estate tax and you choose to borrow money, that's fine. You just don't get to deduct the interest. And then interest that was incurred due to the executor's negligence is not deductible. Because that wasn't necessarily incurred. In addition to the liquidity, that could be if the executor, I don't know, did something improper in administering the estate that resulted in the interest being incurred. The other is that interest on the loans is not necessarily incurred if either the decedent or the executor intentionally created the illiquidity. So that's interesting. You would expect it would be if the executor did it, but if the decedent did it, that would be harder for the IRS to show. Although I guess it's the taxpayer has to show that it wasn't intentionally created by the decedent. But it's something to look out for. And finally is guarantees, payments. If the decedent guaranteed something and got called upon to pay it, that's only deductible if the decedent got compensated for the guarantee. So if the decedent guaranteed his friend's car loan and got called upon to pay it, unless the decedent actually got compensated for the guarantee, it's the equivalent of a gift. So it shouldn't be deductible. So that's it. We perfect timing. Actually, 2 minutes early. I think the key takeaway is that in every estate tax return, if there's a surviving spouse, unless there's a reason not to elect portability, unless the likelihood that the spouse is going to have a taxable estate is sufficiently small, you really ought to be either electing it or strongly recommending that the executor elect it.
Great. Thank you so much, Bruce. If anyone has any specific questions, and I saw there were a couple hands up, or new business opportunities or any other issues they'd like to discuss, please feel free to reach out directly to Bruce or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs, stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my fall webinar series continues on Thursday, October 20th, featuring myself, where I'll be speaking on timely wealth planning strategies for year-end midterm elections in a recessionary environment. It's sure to be a worthwhile program for investors as well as practitioners in the field of wealth management. And I'll send out an invitation to this and all my upcoming webinars after this program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. Finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can feel free to sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow me on Twitter and YouTube. My handle is @Shenkman on Money, and I publish all my put out all my articles and my webinars on social media as well. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.